Ever feel like you're strapped into a roller coaster designed by a toddler? One minute you're screaming, "to the moon!" and the next, your stomach is in your throat. Here in 2026, with AI dominating every headline and every dinner party conversation, the market feels unstoppable. Everyone is cheering as we click, click, click up that massive track. But here's the uncomfortable multi-million-dollar question. Are we at the start of the ride, or is the track about to end? Howard Marks, the legendary investor whose memos even Warren Buffett waits for, says the market spends almost 90% of its time rushing toward an extreme. Yet most investors suffer from a fatal flaw. They think the current trend will go on forever. They confuse a temporary swing for a permanent reality. That mistake? It's the most expensive one you'll ever make. In today's episode, we're continuing our deep dive into Howard Marks's book, The Most Important Thing, to build your market clock and master the pendulum. We're going to look at the mechanical gears that drive every boom and bust, why your brain is currently being hijacked by a crowd of zombies, and how to spot a market hangover while everyone else is still ordering another round of drinks. Stick around, because this isn't just about stocks. It's about learning how to read the vibe of the environment before the drop.
We all experience economic or market cycles every now and then. Usually, we explain them away with things like world events, tech developments, or corporate decisions. However, Marx argues something radical. Cycles aren't accidents or black swan events. They're built into the very DNA of the financial system because humans are involved. To understand this, we need to look under the hood at the gears moving the clock. The first gear is confidence. When things go well, confidence turns faster, which spins the credit gear. Think back to the emerging markets in the mid-90s, the tech bubble in 2000, or the mid-2000s housing bubble. When times are good, banks throw money like confetti. They say, take the loan, leverage up. This easy credit moves the next gear, risk. People stop asking, is this a good investment, and start asking, how much can I borrow? This leads to inflated valuations as people bid up prices, and the machine begins to overheat. As Marx famously says, success carries the seeds of its own failure. Those bad loans and overleveraged bets made in the good times are the literal seeds of the next crash. Eventually, the machine hits a breaking point. The alarm rings. Once those bets start to turn sour, the market self-corrects, usually with a violent contraction. When the crash hits, those same banks who threw confetti will say, "Sorry, we've never heard of you." Credit becomes scarce. Borrowers can't roll over their debts, leading to defaults and bankruptcies, which just makes the contraction worse. This brings us to the pendulum. Investor emotions are like a giant wrecking ball swinging between two extremes, greed and fear, or optimism and pessimism. In a healthy world, the pendulum would sit at a happy medium, but in the real world, it spends almost no time in the middle. It rushes toward euphoria until reality taps it on the shoulder, and then it swings all the way back to panic.
If this sounds a bit too technical, let's put it in a context we all understand: the ultimate party. Imagine it's 8 p.m., the early party. It's a little awkward. There are maybe 3 people standing by the punch bowl, the music is barely audible, and get this, the drinks are free. This is exactly where the legendary returns are hidden, but nobody wants to be there because it's just not cool yet. But then the vibe shifts. Fast forward to midnight, the peak party. This is 1999 or 2007. The music is blasting, people are doing backflips off tables, and suddenly everyone thinks they're a professional DJ. This is when your Uber driver tells you he's quitting his job to day trade whatever is hot. At the top, everyone decides that risk is old school and valuations are just math for nerds. Of course, we all know what happens next. The hangover is inevitable. Eventually, the lights flicker on, the music cuts out, and everyone realizes they've spent money they don't actually have. The takeaway? Your job isn't to predict the exact second the music stops. Your job is simply to look around and notice how loud the party has already become. Now, you might be wondering, if the hangover is so obvious, why doesn't everyone just leave the party at 11:30? Well, it turns out that when the music is loud, our brains undergo a bit of a chemical hijack. The biggest mistake isn't a math error, it's a psychological one. We believe the current trend will last forever, even though the clock tells us it can't. In market extremes, we tend to ignore logic, and the power of those psychological influences should never be underestimated. They are the superpowers that push the pendulum from one extreme to the other. Howard Marks identifies 7 specific psychological demons that start whispering in our ears, making it almost impossible to act rationally. The first one is the most famous: greed. In a bull market, greed isn't just a mild desire for more, it's an aggressive force that overpowers common sense. It's the voice that tells you that doubling your money isn't enough, you need to triple it. It turns level-headed investors into gamblers who completely ignore the risk of loss because they're so blinded by the dream of hitting the jackpot. On the flip side, we have fear. Now, fear is the opposite of greed, but it's just as irrational. It's the panic that hits when the pendulum starts swinging back toward the dark side. It's the urge that makes you sell everything at the absolute bottom because you're terrified of losing that last 10% of your portfolio, even though that's exactly when you should be buying. Then there's the willing suspension of disbelief. This is just a fancy way of saying we choose to ignore logic because the story sounds so good. Think of the dot-com bubble in the late 90s. Back then, people convinced themselves that any company with a .com in its name was worth billions, even if it had zero profits. Investors completely dismissed the math because they were totally sold on the new economy narrative. They didn't want to look at a boring balance sheet when they could buy into a revolution.
But the real pressure comes from our tendency to conform. This is that deep-seated zombie drive to stay with the herd because it feels safe, even if the herd is walking straight off a cliff. That leads directly to envy. This is the physical sickness you feel watching your clueless neighbor get rich off a random AI token while you're being responsible and making 0%. And of course, we can't forget the ego. A reckless bet in good times can lead to the best returns, which bring the greatest ego rewards. When things go right, it's fun to feel smart and have everyone else agree with you. On the other hand, a prudent investor in a hyped-up market just looks stupid. Finally, after all that pressure, we hit capitulation. This is the white flag. It's the moment you finally give in and buy at the very top or sell at the very bottom just to make the emotional stress stop.
All of these are part of human nature, and their ability to compel action is profound, especially when they're at extremes and shared by the herd. They influence others, and none of us should expect to be immune or insulated from them. Marx is very clear here. You will feel these emotions. You aren't a robot. You will feel the pull of the herd, and you might even feel physically uncomfortable standing against it. But to survive the roller coaster, you have to recognize these demons for what they are, psychological traps. As he puts it, reason must eventually overcome emotion. The most important thing is to be a contrarian who is right. So now we know economies and markets cycle up and down, and investors' emotion swings back and forth. How do we deal with it? Let's meet Mr. Market, a character from Benjamin Graham's world. Imagine you own a business with a partner named Mr. Market. He shows up to your door every single day. Some days he's manic, screaming that the bull market will never end and offering to buy your shares at an insane price. Other days he's in a deep depression, crying that everything is going to zero and offering to sell you his shares for pennies. The trick? You don't have to agree with him. You don't have to argue with him. You just take advantage of him. Sell when he's overexcited, buy when he's miserable. The market isn't a calculator, it's a crowd, and crowds are emotional.
So, if the crowd is wrong and the pendulum is swinging toward crazy town, what's your move? You wait. Howard Marks quotes Warren Buffett's famous baseball metaphor here, the hitter with no called strikes. See, in the real world of baseball, if you don't swing at 3 good pitches, you're out. But in the high-stakes game of investing, there are no called strikes. You can stand at the plate and watch thousands of pitches fly by, overpriced tech, hype-driven IPOs, meme stocks, and as long as you don't swing, you aren't out. The crowd behind you will be screaming, swing, trade, do something. But the great investor stays calm and waits for that one perfect pitch, a high-quality asset that's temporarily broken only because the crowd is in a total panic. Only then he swings and hits a home run. This leads us to the art of finding bargains. Marx is very clear. Bargains don't just pop up when everyone feels safe and happy. They are born out of other people's terror.
Think about it this way. Department stores hold clearance sales all the time, and what happens? People lose their minds trying to get in the door. Well, the financial markets also hold a market panic sale every once in a while. But here's the weird part. Unlike a store sale where everyone is a buyer, in a market panic, almost everyone is a seller. Many of these people are forced sellers. They aren't selling because they want to, they're selling because they have to, usually leveraged investors who got a margin call and need to raise cash immediately. They aren't looking for a fair price, they're offering to sell at any price just to survive. That is exactly when bargains start appearing everywhere. In a market panic sale like that, to be the person walking into the market with a shopping cart while everyone else is fleeing for their lives, you need 2 things: patience and preparation. You can't discover a bargain in the heat of a panic. If the building is on fire and you're just starting to look at financial statements, you're too late, or you'll be too scared to move. You have to do the deep homework when things are calm. You need to know exactly what an asset is worth before the price drops. Because when that market panic sale finally hits, you don't want to be guessing, you want to be ready to swing. Patience plus preparation equals opportunity. If you have the cash and the knowledge, a market crash isn't a disaster, it's a clearance sale.
Everything we've talked about, the swinging pendulum, the crazy psychology, the patience, it all comes together in one final concept, the market clock. Howard Marks admits that we can't predict the future, but he insists that we can definitely measure the present. We might not know exactly when the big hand of the market is going to move to the next hour, but we should have a pretty good idea of what time it is right now. Think of a giant clock where the times of day represent the market's mood. 6 a.m. is early recovery. The birds are chirping, but most people are still asleep and haven't noticed the opportunity yet. By 6 p.m., we've hit peak optimism, but then we slide into 9 p.m., the speculative heat of euphoria. That's when the party is at its absolute loudest. By the time the clock strikes midnight, we're in a state of total panic, leading into the 3 a.m. of deep despair.
Your goal isn't to guess the exact second the clock changes. It's simply to know whether you should be putting on your dancing shoes or looking for the nearest exit. To do this, you need to think of yourself as a doctor taking the market's temperature. We call these tools market thermometers. You might remember the ones we've covered in our earlier videos, things like the Buffett indicator and the CAPE ratio. When the reading is red hot, the market actually feels the safest to the average person, but according to the clock, that's exactly when it's historically the riskiest. It's a lot like checking the weather report. You don't need to be a psychic to know it's going to rain. If you look out the window and the sky is pitch black, the wind is howling, and your neighbor's trampoline just flew past your house, you don't need a professional 5-day forecast to tell you to grab an umbrella. In the world of investing, sky-high valuations and widespread greed are those dark clouds. They don't tell you exactly when the first raindrop will hit, but they tell you that the environment is definitely no longer safe for a picnic. Look, at the end of the day, the market roller coaster isn't going anywhere. It's a permanent feature of the financial landscape. But the big difference now is that you're not just the passenger holding on for dear life, you've actually got the map. Understanding these cycles and, more importantly, recognizing the psychological vibe of the crowd is what keeps you grounded when everyone else is losing their heads. Remember the golden rule of the pendulum. It always swings back. History is littered with people who are convinced that this time is different, only to get crushed the second the music stopped and the lights flickered on. Don't be that person dancing on the table while the exit doors are being locked. Use your market clock to stop simply reacting to the daily chaos and start positioning yourself for where the pendulum is headed next. Knowing the time is one thing, knowing how to survive the crash is another. In our next video, the final episode covering the most important thing, we're going to build your survival shield. We'll dive into the actual math and defense strategies to ensure that when the pendulum swings back, you're the one holding the bag of cash. So, stay patient, stay focused, and keep thinking. If you found this helpful, hit that like button and subscribe to join the ride with the Market Thinker. I'll see you at the next tick of the clock.